Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is episode 71 on the VideoCast, 61 on the podcast for the week ending February 26, 2021. And as always, we're going to start off with our media spots and then get right down to the brass tacks. First, I'd like to thank Liz Clayman and Jackie D'Ambrosi Scales for having me on the Clayman Countdown on Fox Business on Tuesday. And the key theme was, rates were rising and the market was starting to show volatility. So, what was happening? And I said to Liz, it's all about rates. 10-year Treasury yields up 50% in 7 weeks. It was up 170% in 7 months. Just think about that, from 50 basis points to, at that time, it was 136 basis points. On Tuesday, it got up to 146. I think we closed out about, backed off of that today, finally, which we anticipated in our article on Thursday, which we'll talk a lot about rates in this podcast VideoCast. But the point that I was making, because a lot of the tech companies were selling off, which we'd been pointing to actually since back in August, FANG has basically gone sideways for the most part and stalled, and the value cyclical trade has picked up. But it's been pronounced certainly this year. You have energy up 32% year to date in just 2 months, relative to tech, which was up about 3%. That was as of yesterday. And the point that I made was that when capital is free, you get a circus of companies that have big promises and little profits. So they're big on their promises and they're little on their profits. And we've seen that. All the IPOs coming out at 30, 40, 100 times sales with no profits. All the SPACs with, some with no revenue. The different pockets of froth that you're seeing. And with rates rising, and the key is the rate of change, managers are now coming to grips with the fact that capital has a cost. And when capital has a cost, investors demand profits. They demand cash flow. And the circus must pack up its tent and move on. And that's really what the market is grappling with right now. Now, that's the intermediate term. We're going to talk about some things that could lead to different bounces in the short term, which I'm pretty excited about, and we'll talk about. But what we saw, certainly as of the Tuesday when I was on the show, was money fleeing out of high multiple tech and continuing the multi-month trend of into cyclicals value. So that's that. And you've seen it with Wells Fargo and ExxonMobil were two of our favorites, both up as of Tuesday, 85% since November, so about 4 months, give or take. And they got up to 90% by Thursday, and they backed off a little bit today. I think they should take a breather here. That's quite a move. And we're going to talk about where we're looking to where the puck's going and where we've been putting money to work this week. The other thing is Chair Powell said that he believes that any inflation that comes will be transitory. He believes that it's soft. So he's going to keep the pedal to the metal at $120 billion a month of bond purchases, low short rates until full employment. And he's kind of in a box. I mean, you can't let up on you can't let up on easing at this point. And the only way you can justify easing is if you do believe or say that inflation will be temporary, because his view is that it's much easier to correct inflation, because we know how that works with Volcker did it in the early 80s, than it is to correct deflation, which Japan fought with for 3 decades, and we've had whiffs of in the last 2. So I totally understand what he's doing. And the other thing that he's doing is he has spoken repeatedly about his fear that a whole group of workers gets left behind, like what happened in the great financial crisis. Many people in their 40s and 50s that lost their job never were able to re-enter the workforce, and that led to the opioid epidemic and really just a terrible situation. So he'd rather run inflation at 3% plus than have a whole generation of people exit the workforce and never re-enter. So I commend him on that front. The other point that I made with Liz is that while money was coming out of tech, that in the intermediate term, the cyclicals are the best bet. We continue to like energy, we continue to like banks, and we definitely continue to like defense and aerospace, which have been our themes for the last handful of months plus, and they've worked. We now see the puck moving in the short term to oversold sectors. Think soup and cereal, Campbell's Soup and Kellogg's cereal. Big pharma, we like Pfizer and Kellogg, and utilities. So we started to see some life, on bounces yesterday and today. But we've been adding to defense and aerospace, and we've been buying aggressively staples, utilities, and some pharma stocks this week. And we're going to talk a bit about that in the article, why we think that's going to happen. But that was the nature of the segment, and I want to thank again Liz and Jackie for having me on to discuss that. Now, moving right along, I want to thank Devik Jain, who put me in his article a few days ago, and that was the day that after Tesla had really corrected quite a bit. I think it was peak to trough close to 20% or a little bit more. Then Cathie Wood of the ARK ETF stepped in and bought $120 million of Tesla. So you had that faux rally in the morning, and then it rolled over again. So I want to thank Devik Jain for including me in his article there. Two of the points that I made to Devik that there wasn't room for in the article was, one, that to keep an eye as earnings estimates we've emphasized since effectively November have been going up every single week into the earnings season, and then through the earnings season they've continued. If you recall, the estimates were down negative 9.7 as of December 31st, and they wound up finishing up plus 3% or so. So much better than expected. However, the last week the trend changed. As opposed to estimates going up every week, they basically flatlined, and they barely ticked up this week, but they did tick up. So that's actually good news, which we'll discuss. Now, let's move right along here. I posted the weekly article, was also posted on Seeking Alpha. The editors put it up this week. And one of the comments someone left was that I talked about 3 to 4% pullbacks, and if you've been following the podcast VideoCast, I've mentioned that in recent weeks that I'd be more inclined to see more shallow pullbacks on a repeated basis, like 4 or 5 mini pullbacks throughout the year, similar to the post 2016 election 2017 environment, which was very similar. Anticipating the tax cuts, which came in January 2018, and that was a sell the news event. And I think that we're in a similar situation, anticipating stimulus and full vaccinations and return to normal, and then it'll be a sell the news type of thing when we actually get it, herd immunity plus. So the gentleman or gentlelady who made that comment said, do you still see that? And, they left that comment last night. I guess they were scared by the selling yesterday, and then they're probably even more scared by the selling today. And so if you look at this chart, the S&P is actually corrected 3.45% off of its highs. So it's right between that 3 and 4% that we were looking for multiples on that versus what would be a more normalized correction, which would be 10%. And it'll be interesting to see if this holds. I think it's going to be dependent on a subject that no one's talking about. I've not heard it anywhere, and you're going to hear it on this, and I think it's going to be pretty surprising for a lot of people. My sense is that this will probably hold up, and we'll probably start to see, which is what I talked about with Liz, is that, and I talked about on the podcast last week, is that the rate of change in rates is going to materially slow down, if not in the short term, reverse. Meaning, and my parting message yesterday in the article, which we published at 6 in the morning, which was written Wednesday night after the close, was that we expect a bounce in bonds in coming weeks, and that would be a catalyst for potentially a bounce in tech, but more likely a bounce into those high-yielding safety groups where managers go to hide when the market is choppy, number one, and when they want to get yield. If rates stop going up, people are going to start looking for yield again, and where are they going to find it? Certainly there's REITs, but my emphasis is on staples, utilities, and parts of big pharma and healthcare. So the other conclusion I had at the end of my article this week, if you've read it, was that I'm not paying as much attention to the general indices right now. I'm paying attention to where will be the rallies under the surface. And if you look at year-to-date performance by sector, now this is from Bespoke Investment Group. You can follow them on Twitter, and that's Paul Hickey. And this was as of last night's close. Now, the S&P 500 was up 2.26% as of last night. It lost 0.5%. So it's up 175 basis points for the year. The Dow was up 2.92. It lost 1.5 points today. So, basically it's up 150 basis points for the year. And the NASDAQ was down 29 basis points for the year, believe it or not. And it gained 0.5% today, so it's up 25 basis points. So it's still the laggard. But if you look at kind of what we're going to talk about today is where's the opportunity, is consumer staples is utilities, consumer staples are the two worst performers for the year, and some of the names are dramatically oversold. And that's a function of it, going back to the beginning of this podcast. Treasury yields rose 50% in 7 weeks. 10-year Treasury yield rose 50% in 7 weeks. So naturally, those got sold off because they're yield proxies, because they're high dividend yielders. As we get the bounce in Treasuries, which I'm anticipating, which I put in the Thursday morning article, which, by the way, we're going to see, just started today. I mean, it's like, better to be lucky than to be good. But look at this dramatic move. Literally, I posted the article at 6 in the morning and we got this reversal. Bonds bounce today. We'll see if it holds. Certainly better to be lucky than to be good. Sometimes you get a combination of both. But nonetheless, that trend that caused such a dramatic sell-off in staples, REITs to a lesser extent, utilities, and big pharma high yielders, with defensive yielders, as people move into a defensive space, i.e. they're moving into bonds, those will come back into favor for the same reasons they went out of favor, and that could be an exciting opportunity. And we're gonna unpeel that in this thing. The other dramatic underperformer as of yesterday is Brazil. I'd definitely be looking at discrete opportunities in Brazil. Mexico, maybe to a lesser extent. I did look at a lot of the Mexico ADRs. There are a couple that were kind of interesting, but nothing to really write home about. And guess what? Treasuries down 12%, which is one of the biggest drawdowns in history, which we're going to delve into as well, and what that usually portended moving forward. So if you look at what's absolutely collapsed in the first 2 months, Brazil, treasuries, utilities, staples, and parts of healthcare. And my saying, Wall Street is the only place in the world when they hold a clearance sale, no one shows up. Well, we were showing up in spades the last few days and buying the hell out of these things. So we'll see how this thesis plays. But my guess is we'll probably get some more pain on Monday, just because I feel so good about the trade, and then it'll work in a couple of weeks, and it'll be a great trade over the next 4 to 6 months. But so that's where we are. The other thing that happened is risk parity, which there's tremendous amount of money in risk parity, which is basically long duration assets to offset equity risk. But the problem now is the quants got hammered because stocks and bonds are moving together. So as bonds went down, stocks went down. And then these guys, as volatility ticks up, they have to delever. It happens every few years. It happened in August of 2017 when these guys almost blew up. I think it happened last year, and it happened this week. So, it's supposed to be a risk-free strategy, and it's shown nothing but risk and subdued returns of late, and that could certainly change moving forward, but that was also part of the kind of abrupt deleveraging. As their models hit, they've got to dump out of this stuff. But again, I'm just going to tease it here. I'm going to talk about a thesis that no one is discussing, and it's going to be pretty mind-boggling here in just a minute. But I want to finish up on bonds. So this is from Macro Charts, and this was posted this morning. So he said TLT, which is basically the ETF for long bonds, long-term treasuries, had its second largest volume spike of all time. That's right here. It had record volume for a down day. The prior was March 18th, 2020, which was the bottom for that. Its drawdown was near the worst. This is long bonds, so TLT. Was near the worst in history, worse than the 2013 taper tantrum. And the price is at key support. He's defining key support as you break out and then you retest the breakout. Okay. And what his point is, any stabilization could trigger a sharp rally in growth stocks. Now, I definitely agree with what he's saying, that if bonds bounce, those assets that do well in a lower rate environment should bounce as well, which would be FANG, which would be tech, but also will be consumer staples, utilities, and big pharma and parts of healthcare. When I say parts of healthcare, I'm talking about the big health insurers like the Humanas of the world, like the Centenes of the world, a number of those type of companies. And I'm talking big pharma like the Pfizers. We also picked up Novartis and a couple other opportunities that are out there. So I agree with all of what he said. I like how he put it in a neat package. We were just seeing an extreme. We got to the same conclusion a different way, but it's always nice to see other data points that are aligned with how you're thinking about things. So, if this bounce persists, then our theme for a short-term opportunity in staples, pharma, and utilities is going to be phenomenal. But it doesn't change the intermediate term new business cycle trend, which we love, which is banks, energy, and defense and aerospace stocks. Defense and aerospace, we were able to add some this week too. That's the cheapest of the three. Banks and energy, I mean, they've had 90 and 100% moves. They have to take a breather. And because everyone's been clamoring for them after they're up 32% in a month, my sense is what has to happen now is probably a 5 or 10% pullback just to wipe out the weak hands, the new money that came in late. They've got to take them to the woodshed. And that would be my bet there. So there'll be better entry points on that. There are discrete opportunities where you can put some starter positions to work there, but I think the pound the table opportunity is going to be in these spaces. So if you're a FANG lover, maybe that will participate with this. I'm going to tell you why I like these three groups better than FANG on a short-term treasury reversal, because I still think the intermediate term trend of yields is going to be up, even though we're going to probably get a nice intermediate term bounce in the long bond, and with these few sectors. But the trajectory intermediate term is up, which will be supportive of banks, which will be supportive of energy. So, if you've been with me for 6 months and you were buying energy and banks at the lows, just ride it out. I mean, you've got so much unrealized profits, or you could take some profits and buy back later if you want to get cute, but why pay the taxes? I mean, unless you're managing institutional money and they don't pay taxes. But this is a longer term multi-year trend, which is consistent with a new business cycle. And rates rising is not a bad thing. It's a sign of growth. It happens in every new business cycle, as do value and cyclicals outperform in the first 18 months. So I'm trying to thread two needles here. What's the short-term trade and what's the intermediate-term trade? And then and tie it all together by the end of this. Now, with all the negativity that's coming in the last couple of days and the VIX spike, et cetera, and people getting nervous, is it going to be a 10% now? I don't really know, but I'll be in buying staples, utilities, and pharma healthcare irrespective. My sense is I probably got most of the opportunity I'm going to get in the last 2 days, and then starting next week, it'll start to get away from me, which will be good. That means we're making money on those. Now, this article was from JP Morgan earlier in the week. Still thinks that the S&P can rally another 12%. This was before we corrected this year as consumer spending explodes for these 7 reasons. I agree with this. My base case since the beginning of the year is still the same, which is mid-teens year for the S&P 500. So, it's just a question of the glide path. And their target is 4,400, implying a 12% leap through the year. I'm right in that range. I like that call. And their 7 reasons are swift reopening. So what's the risk with the reopening? The risk is, and the risk to the market are basically 2 things that everyone's looking at and 1 major thing that no one's looking at, which we're going to get to. The things that everyone's looking for is a variant that knocks things off course that the vaccine doesn't address, and then they got to spend 8 weeks to get the variant vaccine done. Very low probability, but that's a possibility. Second thing is if the stimulus package winds up coming in much less than 1.9 trillion. Possible, not probable. I think they can jam, even though it's a little tricky, I think they're going to jam it through reconciliation, and that's going to get done. Also, okay, so that's number 1, the swift reopening. The stimulus is number 2, so they think that's going to be 1.9 trillion from their lips to God's ears. Even if it's a trillion, it's a lot of money. It's plenty. We've got plenty in the system, but nonetheless, it's going to be big. Pent-up savings. U.S. households are sitting on a record cash reserves with savings totaling about $11 trillion, according to the bank. The unwinding of such funds can revive small businesses and spur new hiring. Agree. Ballooning wealth, markets health through the pandemic can further boost Americans' wealth. JP Morgan estimates rising values across home equity, pensions, and 401k plans will add up to $48 trillion in total net worth. The wealth effect, that's a good thing. And Americans will also be coming out of the pandemic with robust balance sheets. The debt service ratio sits at a 4-decade low. We've covered that in recent weeks. And delinquency rates for consumer loans are at historically low levels. 6, improved job market, falling unemployment rate, growing average work week, and possibly higher minimum wage will all contribute to a healthier labor market. And finally, and this is a big one actually, millennial bump. A record 5 million millennials will reach the inflection point of seeking home ownership. According to the team, increased spending from this group will shift more savings into the economy. So that's that. And then Deutsche Bank put out a note that a new wave of fearless retail investors could be ready to pour $170 billion into stocks, says Deutsche Bank. This is from Barbara Kohlmeier over at MarketWatch. And, quote, with potential direct stimulus payments of $465 billion being planned, this could represent a sizable inflow into equities, $170 billion, said Deutsche Bank strategist Parag That, Srinil Jalagani, and Binky Chadha. So, I guess people are trying to front run them on GameStop. That was pretty crazy this week to see the second coming rising from the ashes. But nonetheless, maybe that's exactly what was going on, front running the stimulus checks. All right, so moving right along. Now, so this is the S&P. So here's the big thing that I've been teasing. So this week, the U.S. intelligence declassified the report tying tying King Salman to Khashoggi's killing. Okay, that took place on October 2nd of 2018. I'm sorry, tying Crown Prince Mohammed bin Salman to Khashoggi's death. So they declassified this report where they basically say, and here's the report, you can see it at CNN.com. The link was actually taken down at the intelligence agency, but CNN still has it up here. And it's from February 11th. They declassified it yesterday. I think it's actually no coincidence that we've seen the volatility in the last 48 hours since they declassified this and made it public. Why do I say that? Okay, so two things. So these are two words you do not want to hear in the next week. This would cause me to change my view from a 3 to 4% correction to a 10% correction. The two words you don't want to hear thrown around this week are Magnitsky Act. The Magnitsky Act is basically what that means is there's a threat that the U.S. government would freeze Saudi assets as retribution for the Khashoggi killing. And why are we worried about that? Is because we saw this happen multiple times during the Trump administration. So it's no coincidence that on October 2nd, 2018, a headline came out at 10:32 a.m. on Reuters that said, fiancé of Saudi commentator Jamal Khashoggi denies Saudi official comments that he left the consulate. Okay? So what happened when that headline hit at 10:32 a.m. where the Saudi government said he did leave the consulate, and then she goes, no, he didn't, and that's allegedly where he was killed. I haven't read the report. They probably say that is where he was killed. What happened to the hour? Oil prices started to slide that day, which, by the way, we've seen oil slide in the last 24 hours as well. And the implication of that headline on October 2nd, 2018 was that the Saudi Crown Prince was implicated. So the bond market got hit, and then stocks topped literally a couple hours after the headline. It was the top for stocks. It was the top for oil prices. So what was happening at that point was that Congress started jawboning about implementing the Magnitsky Act, which would freeze the Saudi assets. So what would any rational person do is, given the amount of wealth that Saudi Arabia has in the U.S. capital markets, which is, by the way, about $500 billion, is that they were trying to get assets out before Congress potentially would move ahead with freezing assets. The Saudis feared that there would be sanctions, and they're selling the U.S. assets to get them out. And the longer it goes on where the government was posturing that we should freeze the assets in retribution, the longer the correction persists. So let's just look to the date so you can see it visually on this. This literally is October 2nd. This was the high in the market right here. October 2nd, you get the headline, and you see massive selling in the U.S. stock market, okay? And then, so that persisted for 2-3 weeks as you had all the grandstanding on Congress, freeze their assets, sanctions on the Saudis, et cetera, et cetera, et cetera. And it started to blow over because President Trump was not really inclined to move in that direction, and said so in so many words. And then this second devastating sell-off in December was fully attributable to Chair Powell raising rates too quickly and nearly throwing us off the cliff. He learned his lesson hard, and he's never made the same mistake since. He's just gone absolutely in the right direction since and saved us from a Great Depression in March. So that was that. But this was a meaningful sell-off once people started talking about, remember these words, hopefully we don't hear them moving forward, which is the Magnitsky Act. If there start to be rumblings about freezing Saudi assets, you're going to see them dump hundreds of billions of dollars of assets. Now, it can be absorbed and it will be absorbed, but they are major holders of tech stocks. Okay, so FANG, which is why even if we get the bounce in treasuries and yields compress in the short term, I'm more inclined to be in staples, utilities, and big pharma, and maybe some health insurers, but effectively big pharma. And so the timing of this sell-off here is uncanny, because look at this top. This top right here, February 11th, 2021. Now look at the report, the declassification, February 11th, 2021. And what's been hit? Apple, Facebook, FANG, okay, is effectively it. And that's what they own. And so now, that's the bad news. The good news is that U.S. says Saudi Crown Prince approved Khashoggi killing, imposes visa restrictions on 76 Saudis. This is CNBC. Now, if that is the symbolic gesture and the punishment that that this administration is going to impose, then we should be fine, and it should be a 3 to 4% bounce, and that should be it. Now, based on President Biden speaking with King Salman, the Crown Prince's dad, this week versus the Crown Prince, it leads me to believe that there are adults in the room. They'll come to some amicable agreement, and if there are assurances that there won't be frozen assets, there'll be other hard sanctions in retribution for the journalist being killed, then this should all be in the rearview mirror, and the weakness that we've seen in tech since, and other stocks and in the stock market, this will be the 3 to 4% bounce and we move on. But this is actually a risk factor now that few people are looking at, that I think either the past administration will pass on, or people in the Treasury Department will pass on, or at the Fed will pass on, because they dealt with this. And they not only dealt with it on October 2nd, 2018, right here, the top, all the way through November 1st, when the market sold off, 15% in a few weeks, literally to the day of the headline, literally to that February 11th declassification, and then the public distribution yesterday and today, and that's why we've seen all this volatility. But they also dealt with it. So let's see, I wrote some notes on this when it was happening in October, and okay, so it's 500 billion. So that's what the Saudis' liquidations in an effort to secure assets is dangerous for the stock market. The stock declines of this year have everything to do with Saudi capital flows and less to do with all the hand-wringing issues you hear and read in financial media. When the Saudis fear sanctions, they sell U.S. assets to get them out, and the longer this goes on, the more they'll sell, as we saw this week, as we saw in October of 2018. And we also saw this with the purge, if you remember. So in November of 2017, if you remember, Saudi Crown Prince MBS ordered the arrest of many of the most powerful Saudi princes. If you remember, he put them up, I think, in the Saudi Ritz-Carlton or something like that for a month. And country ministers, so he arrested all these people, the Saudi princes, the country ministers, and business people on corruption charges. He locked them up in this five-star hotel, and more than $100 billion of assets were claimed to be under investigation. A third were frozen in what was called the Saudi Purge. These subjects were detained for nearly 3 months, and the timing of their release and the market correction of January of 2018. So remember, they were arrested in November, they were held for 3 months, and they were released on Saturday, January 27th. Now look at the stock market the day they got out, the next Monday. That was the top, January 27th. They get out, and boom, another 15% correction, dumping everything they can get their hands on to raise cash. So these are not coincidences, and that's why I'm saying this is what would change my mind. Now, if it's rear view mirror and President Biden spoke with King Salman and he said, look, I'm not going to freeze your assets, but we have to take sanctions. We have material information that there was involvement. We declassified it. It's unfortunately an embarrassment for you. It's a tragedy for America. And we have to do X, Y, and Z to make it right, then it'll be fine. We'll just bounce. But if they go into this, or you get congressional grandstanders that didn't learn their lesson in October of 2018 or in January of 2018, the last two times that wealthy Saudis and feared asset freezes and they sold everything that wasn't nailed down, then it's more likely we would get that full 10 to 15% because they're going to be dumping everything under the sun. I think that this is like a slow motion car wreck, meaning it's been so telegraphed and probably back channeled that it won't be the same. It won't be the surprise that it was in October of 2018 or in January of 2018. But we have to keep our eye open for this, and it is something that no one's talking about, and I do think it has everything to do with the volatility we've seen this week. More so than rates rising 50% in the last 7 weeks or 170% in the last 77 months, because we've known that's happening. It's been happening, and it wasn't surprising to anyone. Although maybe the last 7 days was a little bit abrupt. So it was all part of it. But for all we know, they could have been selling off treasuries to raise cash ahead of the expected declassification. So anyway, it's an edge that no one's focused on, that we can be focused on. Now, how would that change anything that I'm doing? It wouldn't change anything. I mean, these staples, utilities, and big pharma that we picked up hand over fist while they were throwing a clearance sale this week, they can sell them down more. I'll be a buyer. I'll be happy to buy it. But those are not the areas that would be most hit. I think the number one stock that I've been telling everyone in the last few podcasts to watch is Apple. Because Apple, if you recall, reported perfect earnings, and it's been down basically every day since, and closed week today too, even after a bounce in the morning. So this is in distribution. We'll see if this gets a bounce. If treasuries bounce, does Apple bounce with it, or does Apple stay weak? We got to keep an eye on that. That's really the key to the market right now, in my view. Continue to watch Apple. That's another thing people aren't paying a lot of attention to. Certainly more so than potential wholesale selling if Congress goes in a direction of those fearful words, Magnitsky Act. That's going to have implications on the stock market, because if someone told you they were going to freeze all your assets, you'd be selling everything not nailed down too. You can expect them. The difference is, it's one thing to be selling down 20 or 30 million bucks. It's a whole different thing to be selling down $500 million or $1 trillion. It's night and day, and we saw that impact in the market. All right, moving along. Okay, so that is everything I wanted to say about. And by the way, leaving aside what I'm trying to discuss as it relates to this is the impact on the stock market. I'm not saying whether we should or shouldn't do the Magnitsky Act and freeze assets and do all that stuff. I'm just saying what will be the implications if Congress tries to grandstand or move in that direction. Because part of the reason that this was such a pronounced and long-lasting sell-off in October of 2018, and it went from October all the way through November, and it just kept cascading, it's because every day you would have a new congressperson or senator on TV talking about freezing their assets, sanctions, Magnitsky Act, and it was just relentless. And most people actually do not attribute or do not correlate that correction with that, but that's actually what structurally was happening. If you talk to people who saw the flows, that's where it was. And there's a lot of FANG owned there. So keep your eye on Apple, and hopefully you don't hear that word Magnitsky Act in the next 72 plus hours. Okay, more. Okay, this article from U.S. News: Biden on the campaign trail was deeply critical of Saudi Arabia, saying he would see that they pay the price and make them, in fact, the pariah that they are. The Saudi ruling family and government it oversees has, quote, very little social redeeming value, he said. The statements represent a clear break from the administration of then President Donald Trump, who rarely criticized Saudi Arabia and considered the kingdom a key part of his ambitions for the region, namely containing Iran and achieving high-profile peace deals. His son-in-law Jared also developed a strong personal relationship with the Crown Prince. The U.S. may still apply sanctions on Saudi Arabia under the Global Magnitsky Act, the 2016 expansion of the 2012 legislation initially designed to allow the U.S. to punish Russia for the death of former tax advisor Sergei Magnitsky, who exposed widespread theft and fraud before his gruesome death in a Moscow prison. That law affords the president significant flexibility in exacting targeted sanctions or other forms of financial and diplomatic punishments for human abusers. Khashoggi's killing sparked a crisis in 2018, and details slowly leaked about his... Okay, so that's that. And that article, U.S. News, was Paul Shinkman. Today, U.S. Saudi Crown Prince ordered Khashoggi's murder. Okay, so that's that. Hopefully from a stock market standpoint, maybe you'd say, screw the stock market. Justice has to be served. If we correct 20%, we correct 20%, freeze all their assets. But that's fine if that's the direction they go, but then just know what's going to happen with the stock market. But, this visa restrictions hopefully will be, from a stock market standpoint, the bulk of the retribution. Maybe they'll be required to do I thought they did a payment to the family, but maybe they'll be required to do a big payment to the family. Or something along those lines. All right. In other news, more geopolitical stuff, which we've talked about in the context of defense and aerospace stocks. Syria/Iran condemn U.S. strike on Iranian-backed militias. So we striked Syria last night. It's interesting because Iran has basically stopped flash inspections of their nuclear sites, which is not a good thing. I'm sure Israel's not going to like that, which is going to make it harder to get a deal done, or easier. It depends on how you view the administration. But the point is, after 4 years of relative geopolitical calm, it's off to a bumpy start in the sense of, tension now immediately with Saudi Arabia by releasing this report. And keep in mind, with us shutting down production, OPEC gets to name their price. And as we promised last year, based on all the production that was shut down, and earlier this year when they stopped drilling on federal lands and shut down pipelines, that we'd see $3 and $4 at the pump. Well, we saw it this week. Gas surges above $3 in these states as oil prices jump. Now, moving forward, since we're not going to be the key producer anymore, and within 12 to 24 months we're actually going to be importing oil from the Middle East, they will have power over us and be able to name their price. OPEC will become strongly relevant again, and starting on this foot, knowing that we're going to need them for oil since we're shutting down our own ability to produce, is risky. And that's when military, historically, a lot of military engagement has been related to oil and U.S. interests in the Middle East if we don't have our own production at full tilt. So anyway, it's another risk. So moving along, This is Iran limits access to nuclear sites, but open to talks with the U.S. So they want money, and we'll see. Maybe they'll just give them the money, and that would be unfortunate, but it's just a difference of style. Okay, so this is bespoke a second group of performance metrics. This is month to date versus year to date. Year to date, we've covered again. Staples, healthcare, and utilities were the three underperformers, and that's where we want to buy. If you followed me for more than a week, I don't buy up. I buy weakness. I sell strength. I buy what no one wants. I sell it when everyone wants it, and it's just a difference of style. Some people like to buy when everyone wants it and hope there will be more people that want it after them, and that works for some people, particularly retail traders that are trading smaller amounts of money. That can be very, very nimble. That can work very well for. But what we do here is we buy weakness, we sell strength. Okay, the skew index. This is basically we've covered this many times, but it's still elevated here. And how to think about this is very simple. The primary difference between the VIX and the skew is that the VIX is based upon implied volatility around at the money strike price, while the skew considers implied volatility of out of the money strike prices. So effectively, people betting on 2 standard deviation events or black swans so in other words, this is elevated now to 148, and now it's coming down, meaning a lot of people are taking out tail risk insurance expecting potential black swan events. Historically, when that starts, about a month later you get a correction, which we've covered. About a month later you get a correction. About a month later you get a meaningful correction. There are exceptions, and the exception again points to none other than early 2017, right after the election. So you got the elevation, and as you came down, you got this sideways chop for a few months, which we've been talking about and expecting, and then multiple 3 to 4% corrections, and it burned right through, and people kept buying this risk, and they didn't get paid. So although the odds favor a more meaningful correction when you get elevated to around 150, and then a month out you get a correction, it doesn't guarantee it, and I think we are in unique times in that we may burn through it here. But a lot of that, I think, now is going to really be determined on whether the issues with the Saudis and their $500 billion in our U.S. capital markets are resolved, and we're committed to not freezing them. Because if we start posturing that we're going to freeze them, all bets are off. And that's a new development that has to be considered. I'm of the opinion, I think, I'm trusting that politicians are going to do the intelligent thing, but that might be a mistake. But I think we've had 2 looks at what it looks like to fumble the ball, and if they want another one of these and another one of these, then by all means go for it, have at it. But it's not in anyone's interest, particularly when we've spent trillions of dollars of stimulus and monetary policy to hold the economy together. Now's not the time to play games about something like this. Get the growth to 6%, get back to full employment, and make them pay back later. Show a little self-restraint in the short term and collect the bill due in the intermediate to long term when we're on more solid footing. Okay, Pfizer and BioNTech studying third COVID-19 vaccine dose to fight new strains. So they're already, trying to get ahead of the curve on that. Moderna, the CEO was on saying he can basically change his thing in 8 weeks and fix it, but then you got to ramp up the production. So it's a complicated thing. My bet is that these new strains will probably get closer to herd immunity before they become meaningful, but that's an embedded risk in the market. I think it's a low probability risk, but it's something to consider. All right, on to the TikTok hit it, get it stock market and sentiment results. This one we had a lot of fun with. The good news is we've covered a lot of the substance in the article, so we're going to be able to wind down in the next handful of minutes. But so this young guy on TikTok getting excited about the J&J vaccine, which, by the way, was approved for emergency use after the close today. So that now we've got a third vaccine, a single-shot vaccine with relatively good efficacy. This is purely from memory, but I think it was at 75%. You can just Google it, but that's good news. And he did it to this song. Maybe I can play it a little bit here, and you can.
Hit it, hit it, hit it, hit it, get it, get it, get it, get it. Ow, ow, ow. Show them, girl, yeah. Boom, boom, bow, bow, boom, 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 bow, 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 boom, boom, bow, 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 boom, boom. Ow, grrr.
All right, so that's entirely too much fun for a stock market article. But leaving that aside, the point was that this is the hit it, get it stock market. So, like I said, that I like to buy when a group or company's out of favor and sell it when everyone's clamoring for it. We did it with banks and energy in recent months. And while the market was hitting it, okay, these are the red arrows here. You see Wells Fargo. We were getting it and building our position. Same thing with, and now it's was up as much as 90% off the lows this week. Now it's probably back to up to 87%, whatever. Exxon, same thing. The market was hitting it for 6 months. Us were getting it, and now it's up 90% off the lows. Same thing with defense and aerospace. The market was hitting it. We were getting it. This is a triple levered ETF called DFEN. It's just a leveraged version of ITA or XAR. It's a compilation of the biggest defense and aerospace names like the Northrop Grumman's, Lockheed Martin, General Dynamics, Raytheon Technologies, Boeing, etc. We love this group. It's still cheap as heck. And speaking of which, we got a Ask Me Anything question from Israel, from Nir Gal. Thank you so much for emailing me. His question was, or her question, his question. Hello, and thanks for all the knowledgeable insights you provide all the way to Israel, which is really cool. I really appreciate the education you provide weekly. I may owe you, smiley face. My question is about leveraged ETFs such as DFEN that you talked about last week. You said, quote, you need to know what you're doing to play with those. Can you expand on the tactics and strategies, please? I thought I can have the same exposure while setting money aside to pick stocks under the hood, as you say, instead of having X on ITA, which is the defense ETF, VDE, which I guess is Vanguard's energy ETF, and VFH, which I guess is their financial ETF, have 0.3 times or 30% on a leveraged ETF and some money to buy individual stocks. Thank you, sir. Okay, so here's the thing. With leveraged ETFs, they can break and they can just shut them off, and you can and you can get, they can just take your money. They can just shut it down. With like a regular ETF, they have to give you the underlying stock if they're going to shut down the ETF. So that's the risk. The good news is they're not incentivized to do that because the fees on leveraged ETF are really juicy. So the point is that the more AUM is in the ETF, the lower probability of it getting shut down because the fees are so thick. So it's just something that you need to be aware of. Even though it's a 0.1% probability, it's a possibility because they get the 3 times leverage through derivatives, so they're not going to distribute out the options if they shut down the fund. So it's something you have to keep in mind, and it's a risk. So you have to in your mind say, let's say it's a 10% exposure, which is effectively notional exposure of 30%, which is really overweight, which is really aggressive. Would you be okay with losing that 10% of your portfolio? That's number one. Number two, if you have a move where the sector goes down 4%, this thing could be down 12 or 20%. Can you deal with that volatility? So it's not a free lunch. So you have to know how you're playing it. And we do a lot of single name stuff around it. it's not a first choice, but it's an option. And but again, I'm dealing with accredited investors. I'm dealing with qualified institutions. I'm dealing with my own money. And I am comfortable with that volatility and risk, as are most sophisticated investors, and particularly how we size it and manage the risk. And we have other hedges on. But on a standalone basis, my general sense is for a retail investor or someone newer, you're better off never using any leverage until you generate consistent returns over a long period of time, and you've been through multiple cycles and you know what you're doing. So that's my general thing. This is not advice. This is opinion. Click on terms at the top of the website. So my view is, if you can deal with mass volatility, and let's say you're going to put in 3% of your portfolio, and you say, okay, if it goes to 0, it's not the end of the world, then yeah, that's a good way to get exposure, and then you could have more in other names. But just know that, and you got to read the prospectus. I mean, how do they distribute it if it's shut down and that kind of thing? Again, this is like less than 0.1% of a possibility, but there are no free lunches. So, if you just look at this move off the bottom, it was up 143% in basically 2 or 3 months. It was up 143%. So that doesn't come free. And you saw what happened during the pandemic. The thing lost like 90% of its value. So there's volatility embedded. The key thing is here, I'm making a bet that we are at the beginning of a new business cycle, and this is going to slowly chop up over time, over the long term, and build it that way. So short answer is I'd probably go for new leverage. I'd pick the top 5 biggest names and just get exposure there, or the regular ETF with no leverage, ITA. If you're aggressive and you're comfortable with a portion of your portfolio laying on the risk, then that it's a free country. You can. Both countries are free. That's pretty cool. We got an email from Israel. All right, moving along. Now, so that's what we've done, past tense, and moving forward, what we're doing now is, again, staples, utilities, and big pharma. So we named 6 names on the Liz Clayman interview. You should listen to those 6 names. They were Dominion on the utilities, Dominion and American Electric Power. On the pharma, we picked up Pfizer this week and Novartis. And then on the staples, soup and cereal, Campbell Soup and Kellogg Cereal. And there are a number of them. And by the way, if you look at cereal consumption, obviously it went off the charts with the pandemic, but there's a case for this persisting based on demographics and, millennials having kids, and the game is back on. I mean, look at this hockey stick in Cheerios. Look at this hockey stick in Kellogg Natural cereals, grape nuts. So these trends that were in secular decline are now in secular ascent, we believe, and people are liking cereal again. We'll see. Okay, so this is just a re-emphasis on Kellogg. The market was hitting it. Now we're getting it. Same thing with Novartis. Market's hitting it. We're getting it. See how the theme ties? And then Dominion, hitting it. We're getting it. And that's where we see opportunity. Now, if you're on the podcast, this will cut off in the next minute. Just go to hedgefundtips.com, go to the VideoCast, fast forward to minute 60. You'll pick up word for word exactly where you left off and get the last five or so minutes. In addition to the soup story, or the cereal story we just covered, P&G CEO expects higher demand for cleaning products to outlast pandemic, and he goes through his narrative about that. So those are valuable on top of the underlying thesis, but we just spent 45 minutes covering the structural reasons we believe these 3 groups are going to work in the next few months. So that's that. We covered the thing about free capital from the Clayman Countdown. We also covered that when rates rise, what groups are hit disproportionately. You can take a look at that in the article. And okay, defensive groups. The other thing is, energy up 32% year to date. So that's going to continue intermediate term over the next 18 to 24 months. I think short term, energy and financials, I mean, look, it can't go up another 90% in the next 6 weeks on top of it. It's got to take a breather, wipe out the new money that came in too late, and then resume higher for the new part of the business cycle. This just shows that S&P Energy Index is on track for its best month ever relative to the S&P 500. That's amazing. The last time it had a month like that was 2003, 2004. If you remember, energy just kept going till 2007 plus. I mean, it was a multi-year, multi-bagger rally for pretty much every name in the sector. And then the same thing happened this month, that it was the best month for growth, best month for value versus growth since December of 2000. Now, if you recall, tech rolled over in March of 2000 and value took the reins. And from 2001 to 2007, value and energy and commodities and emerging markets all outperformed. Cyclicals outperformed. So the fact that this is the biggest month since then, which was the beginning of a new cycle for cyclicals and emerging markets and commodities and value, is promising if you're in the value camp, and that's normal with the new business cycle. Retail sentiment this week was in euphoria still, so we're seeing some of that euphoria get taken off. The fear and greed index was at 63. I'm sure that's probably down below 50 as of the end of today. And then the active investment managers were at euphoric levels. They changed today, knocked down to the mid 80s, so they've gotten scared out yesterday. And the message for the week is that we'll continue to add to defense and aerospace, which we've done on any weakness, and on the second half commercial aviation recovery thesis. We also covered some geopolitical risks that will draw attention to the low valuation in those groups. I think that's a huge opportunity. Banks and energy, you just have to ride the volatility. If you own it where we were talking about it, you're up a lot, or take profits, your choice. But we're holding this. We think this is a multi-year play. And then we're building up selective positions in consumer staples, utilities, and big pharma. Yesterday and today, we just laid into it because the opportunities were just being served up like nobody's business. And this would also imply that we could see a possible short-term bounce in bonds in coming weeks. Keep in mind, this was published Thursday morning from Wednesday night when I wrote it. And sure enough, the bounce has begun. Just refresh that one. So here's the bounce in the last 2 days. Pretty cool. I'll take luck any day of the week. Remember, pay less attention to general indices as there are many crosswinds at present, and more attention to take advantage of the rallies under the surface through sector rotation. We did the serial. Here you see what I was talking about. Estimates have been going up, and they've been basically flat the last 2 weeks, basically flat 2 weeks. So you got to keep your eye on that. And then finally, some of the economic data this week. Rig count went up modestly. Consumer sentiment was good. That's great news. Obviously, $900 billion has something to do with that. That got distributed. Consumer expectations beat. That's good. Chicago PMI was weak, so keeping an eye on that. Personal income was up 10% from the stimulus. That was better than expectations, and expectations were high. Core CPI price index was up. That's, obviously whiffs of inflation down the road. Natural gas draws were larger than expected, so keep an eye on that. We talked about that 2 weeks ago. We think there's going to be a shortage in coming months. Pending home sales were weak because rates rose. It's probably not the full story, but that's part of the story. Initial jobless claims were better than expected, so that's good news. Continuing claims stopped going up as they did last week, so that was better than expected. With the country reopening now, that's going to continue to get better. Durable goods was good, and GDP was revised down a little bit for Q4 to 4.1%. We actually had a build in crude this week, 1.28 million barrels, which we haven't seen a lot of, maybe less than a handful since June. So that's worth keeping an eye on. Distillates did have a big draw, though, so that was good to see. And this potentially has something to do with Texas. We'll see how that shakes out over the next few weeks. And that's all the major economic data for the week and earnings. So we had to go through quite a lot of new stuff this week, some nuanced ideas. I guess the takeaway is the market served up enormous opportunities that we talked about last week in 3 sectors, and they really, it was a tremendous opportunity this week. Maybe they'll serve up more next week. What's low can go lower, but on balance, that some of those stocks and groups felt near capitulation, and seeing the reversal in bonds tells me that those are probably going to see a bid in coming weeks, and potentially an aggressive bid in coming weeks. As far as the bigger risks I outlined, you have to be cognizant of that. It's largely in the hands of the politicians. My sense is that by Biden acting diplomatically and having a phone call with King Salman versus the Crown Prince, and trying to work it out that way and not being terribly vocal about it, it seems to me that he's taking the correct tact to maintain stability and not undo, 9 months of trillions of dollars to, glue the vase back together, so to speak, after it, fell off the table last March. So my expectation is a sensible response to this, and some type of, financial payment or symbolic sanctions like you saw with the 76 visas. And then, the Saudis can be assured that they don't have to sell off hundreds of billions of dollars of assets next week to, get them out of the U.S. before they get frozen. That wouldn't serve anyone, and I think it's a low probability, but it is a probability that now has to be considered, and I think it speaks a lot more to the activity in the last 48 hours than does bond yields rising, which we've known about for many, many weeks. So with that said, we'll be back next week, same time, same place. Make it a great one.